here is a recent trade I just closed, and as you can see, that's an impressive gain of over 160 pips in the total profit. But the question is, how did I know that this was the right move? And it's simply because of the confluence of multiple technical analysis aspects. So in this video, I'm going to take you through the exact technical analysis techniques that I use on a daily basis, so that way you can read and understand the market, become a more successful trader, and of course make trades just like this one over here. So now that you are intrigued how technical analysis can guide your trades, let's dive into what it actually is. So technical analysis is basically a method used by the traders to understand and predict the future direction of the market prices, and it's built on three basic ideas. So the first idea is that the current price of a currency pair reflects everything that's currently known about it, and I mean that starts from the global events, news, and trader sentiment. So the second idea is that technical analysis recognizes that prices typically move in trends, and we are talking about upward, downward, or sideways. And lastly, technical analysis involves looking at the past price changes, because very often the way prices moved in the past can actually give us hints about what they might do in the future. And this analysis helps us to make more informed decisions about when to buy or sell based on the likelihood of what the market might do next. Okay, so now that we have set the stage with what technical analysis is all about, let's dive into our first major topic, which is understanding market trends. And market trends are essentially the direction in which the market is heading. So in trading, there are three primary types of trends, which are uptrends, downtrends, and sideways trends. So an uptrend in a market is like a series of ascending steps, and on the chart you will see this as a pattern of higher highs and higher lows. So each high is a peak where the price reached before pulling back, and each low is the point where the price stops falling before climbing again. And of course, in an uptrend, each new high is higher than the last, and each low is also higher than the previous one. So this pattern suggests that the buyers are in control, pushing prices up. Now, downtrends are literally the opposite of an uptrend. So on the chart, this appears as a pattern of lower highs and lower lows. And as for the downtrend, each new high is lower than the previous one, and each new low is also lower than the last. So this pattern signals that the sellers are taking the control, driving prices downward. And the last type we have is the sideways trends, or let's say range bound markets, which occur when the market isn't making any significant moves up or down. So this basically suggests a balance between the buyers and sellers, with neither side gaining a definite upper hand. Okay, so how do you spot these trends on your charts? And the key lies in connecting the dots, well, in this case, the highs and the lows on your price chart. So let's break it down. So in an uptrend, you start by connecting the series of higher lows, and these are the points where the price reverses upwards after a dip. And as you draw the line through these points, it should slope upward, forming what we call an ascending trend line. And a very important thing to remember is that the more often the price touches this line and bounces back up, the stronger the uptrend is considered. Now for the downtrends, you basically need to connect the lower highs, and these are the peaks where the price turns downward. And the validity of the downtrend is very often confirmed when the price hits this line more than 2 times and then continues to drop. And for a sideways trend, in this case, you need to draw horizontal lines at the upper and lower points of the price range. So these lines represent the resistance, which would be marked as the upper line, and support the lower line levels of the range bound market. So always keep in mind that the market conditions can and will change all the time, so as you draw them, remember to adjust the trend line as new price data comes in, just to keep your analysis current and relevant. Okay, so now that we have got the hang of the trends, let's shift our focus to something equally important, which are support and resistance levels. So support is basically a level where the price tends to find what I like to call a floor and bounces back upwards. And this level forms because of a concentration of demand, or let's say buying interest at a certain price level. So when the price drops to this level, buyers see it as a favorable opportunity and step in, which basically pushes the price back up. Now, a good and reliable support level is often established by history of the price stopping and reversing at this level multiple times. So the more times the price touches and bounces off support without breaking it through, the stronger and more significant it becomes. Now, resistance on the other hand is like a ceiling where the price tends to hit a top and falls back down, and it usually forms due to accumulation of supply or selling interest at a specific price level. So when the price rises to this level, usually sellers perceive it as an advantage point to sell or take profits, resulting in a downward pressure on the price. Now, a strong and reliable resistance level is very often identified by the price reaching and reversing from this level on several occasions, and its reliability increases when the frequency of the price reaching this level and failing to break through it. So engaging in trades near these levels can be actually a very strategic move, because you might consider buying when the price is bouncing off the support or thinking about selling as it falls from the resistance. However, as a trader, you always have to stay alert for potential breakouts, and breakouts occur when the price decisively moves past a support or a resistance level, which could signal the start of a new trend. Okay, so now that we have talked about support and resistance, let's pivot to a topic that's equally important in technical analysis, and we are going for candlesticks. Now, candlesticks are the building blocks in trading, and each candlestick represents price movement within a specific time frame. So this could be a minute, an hour, a day, or more. So candlestick consists of a body and may have one or two wicks, or what we call shadows. So the body of the candlestick shows the opening and the closing prices, while the wicks represent the highest and the lowest prices during that period. So let's actually talk about the two main types of candlesticks that you will encounter in trading, and these are the bullish and bearish. So the bullish candlestick occurs when the closing price is higher than the opening price, and in a bullish candlestick, the bottom of the body represents the opening price and the top of the body shows the closing price. Now, a wick extending above the body signifies the highest price reach, and a wick below indicates the lowest price. So bullish candlesticks suggest that the buyers were in control during that period, pushing prices upwards. Now, bearish candlesticks are literally the opposite of bullish ones. So in a bearish candlestick, the top of the body represents the opening price, while the bottom shows the closing price. So the wick above the body indicates the highest price reached during that period, and the wick below shows how low the price dropped. So bearish candlesticks simply tells that the sellers were dominant, driving the prices down. So to make this even more clear, let's take a look at a couple of specific examples, because these will help you better grasp how the size and the shape of the candlestick can literally tell you the underlying market sentiments. So consider a bullish candlestick with a large body, no lower wick, and a small upper wick. So this pattern typically indicates strong bullish pressure, because the large body shows a significant increase from the opening to the closing price, and the absence of a lower wick suggests that the price didn't drop below the opening level during this period, indicating that the buyers were in a firm control right from the start. Now, on the other hand, let's take a bearish candlestick with a small body and a very long upper shadow. So this pattern often reflects a bearish sentiment, and that small body suggests a very minimal change between the opening and closing prices. However, this extended upper wick reveals that the buyers, they really try to push the price up, but ultimately sellers overpower them, pulling the price back down. So this kind of candlestick, especially following a price increase, can indicate that the sellers are starting to outweigh the buyers. So with that said, let's explore three of the most popular candlestick patterns and the meaning behind them, because understanding these patterns can be a game changer in how you read the charts and actually make your trading decisions. So the first one is Marabuzu, and Marabuzu is basically a distinctive pattern categorized by a long body with no wicks at either end. And this full body candlestick basically represents a market session where one side, so either buyers or sellers, had complete control. So a green Marabuzu is where the closing price is at the top of the body, signifies a strong and consistent buying pressure throughout the session. Now, the lack of the upper and lower wicks indicates that the opening price was also the low of the session and the closing price was the high, basically highlighting the buyer's dominance from start to finish. On the other hand, a red Marubozu closing at the bottom indicates a very strong and dominant selling pressure. So the absence of the wicks means that the open and close were also the low and the high for the period, and that basically highlights the strength of the bearish sentiment. So moving on, we have engulfing patterns, and engulfing patterns are two candlestick formations that signal a potential reversal in a market trend. Now, in a bullish engulfing pattern, a small red candle is basically followed by a large green candle that completely covers the first one, and this setup indicates a very strong shift from selling to buying pressure, and that often suggests the beginning of an upward trend. On the other hand, a bearish engulfing pattern features a small green candle, which is the first one, overtaken by a large red one, which is the second candle of this formation, symbolizing a change from buying to selling pressure and even potentially marking the start of a downward trend. So usually engulfing patterns are typically known for signaling potential trend reversals. However, it's important to know that engulfing patterns can also be interpreted as a continuation pattern depending on the prevailing market condition. So for example, a bullish engulfing pattern appearing in the middle of ongoing uptrend could literally reinforce the existing bullish sentiment, which basically suggests you the continuation of the upward trend. And this rule basically works very similar to a bearish engulfing pattern during a downtrend that might indicate that the bearish momentum is still very strong and the downtrend is likely to continue. And lastly, we have a shooting star. So the shooting star is a candlestick pattern that traders pay close attention to, as it often signals a potential reversal of an uptrend, and it definitely looks like a star falling from the sky. It has a small lower body indicating that there wasn't much difference between the opening and closing prices, and a long upper wick. So this long wick over here is key because it shows that during the session the price shot up significantly but then fell back down. Now usually this pattern suggests that the buyers initially pushed the price up, but it couldn't maintain that momentum and sellers took over, driving the price back down. So when you see a shooting star after a period of an upward price movement, it could be a sign that the uptrend is losing steam and a bearish reversal might be on the horizon. So far we have looked at the candlestick patterns which focus on individual bars on your chart. Now let's broaden our perspective and talk about chart patterns. So chart patterns basically encompass multiple candlesticks to form a larger, more significant shapes on your chart. And these patterns can actually tell us a lot about what the market might do next. So let me show you my top 3 chart patterns that I love to trade. So the first pattern I really like to keep an eye on is the double top. So the double top is a very well-known reversal pattern that typically forms after an uptrend, and it's categorized by 2 peaks at roughly the same level, forming an M letter shape. So this pattern usually signals a potential reversal from bullish to a bearish momentum, but the key moment for the double top is when the price breaks below the neckline. So this break below the support level confirms the pattern and suggests that the sellers are now gaining control. So the second pattern that is always on my radar is the head and shoulders, and this is another reversal pattern, and it's basically considered one of the most reliable ones. So the head and shoulders pattern appears at the end of an uptrend and is categorized by the 3 peaks. So we have the left shoulder, the head, and the right shoulder. And the head is the highest peak and the shoulders are slightly lower but at a similar level. So in many cases, the formation of this pattern indicates that the uptrend is actually weakening, but a key signal of the pattern's completion and thus a potential downward reversal is when the price falls below the neckline, hinting that the bears might be taken over. So after exploring the double top and head and shoulders patterns, patterns, which often signal trend reversals, let's shift our focus to a pattern that's more about continuation. So this brings us to the flag pattern, and that comes in two types, which are the bullish and bearish. Now, a bullish flag forms after a sharp upward price movement, creating what we call the flagpole. And following this, there is a slight downward sloping consolidation forming the flag. So the confirmation of the bullish flag pattern comes when the price breaks out above the upper boundary of this consolidation zone. So such a breakout is a key indicator that the initial bullish sentiment is still strong and the market is likely to resume its upward trajectory. The bearish flag pattern is essentially the inverse of its bullish counterpart, typically occurring during a downtrend. And it all starts with a sharp decline forming the flagpole driven by a strong selling pressure. And then the market experiences a slight pause or minor upward correction forming the flag portion of the pattern. But the key signal for continuation of the downtrend is when the price decisively breaks below this lower boundary of the flag. So this breakout indicates that the bearish momentum is still there and it's resuming, suggesting that the prices are likely to continue falling. So candlesticks and chart patterns tell part of the story, but to get the full picture of what's happening in the market, let's add technical indicators to our analysis. So the first indicator, and probably one of my favorites, is moving average, and that's a fundamental indicator that basically smooths out the price fluctuations over a specific period. So the two most popular types are the simple moving average and the exponential moving average. So the SMA calculates a pretty straightforward average of prices over a set of period, while the EMA gives more weight to recent changes, making it more responsive to new market information. Now, effectiveness of a moving average in trend identification depends on the time frame you choose. So a shorter moving average like a 10-day or 20-day is more sensitive and closely follows the price, making it more suitable for short-term trend analysis. On the other hand, a longer moving average, so let's say 50-day, 100-day or 200-day moving average, smooths out price volatility and reflects a longer term trends. But besides trend identification, simple moving averages are really great tools that can act as a dynamic support and resistance levels. So for example, if the price repeatedly bounces off this 50-day moving average and moves higher, this moving average is acting as a dynamic support. On the other hand, if the price often falls after touching the 200-day moving average, this moving average is serving as a dynamic resistance. So having covered moving averages and their role in trend analysis and as a dynamic levels of support and resistance, let's move to another pivotal indicator in our technical arsenal, which is the Relative Strength Index, or RSI, which is a momentum oscillator that measures how rapidly prices are changing. So if the RSI value is over 70, it suggests that the asset might be overbought. It's very similar to stretching a rubber band too far, so it might snap back. On the other hand, an RSI below 30 indicates the asset could be oversold. So in terms of trading signals, the key RSI levels to watch are 30 and 70. So an RSI value below 30 often suggests a potential buying opportunity. Conversely, the RSI above 70 could potentially pointing to a selling opportunity. So our final stop is the MACD, which is a trend following momentum indicator that shows the relationship between two moving averages of an asset. So this indicator consists of the MACD line, a signal line, and a histogram that basically displays the distance between the MACD line and the signal line. And in many cases, the most popular way to trade MACD is to look for a signal line crossovers in order to basically generate buy or sell signals. So for example, when the MACD line crosses above the signal line, it's a bullish signal suggesting it may be time to buy. Conversely, a cross below the signal line might indicate a bearish trend, signaling a potential sell opportunity. So we have covered a lot from from support and resistance lines to candlestick, chart patterns, and even dived into some key technical indicators. And now I think it's time to bring all of these elements together, because it's one thing to understand each part of its own, but the real power of technical analysis lies in how these tools can be combined in actual trading scenarios. Okay, so let's take a look at this chart and break down what's basically happening. And we are starting strong with a clear downtrend indicated by a lower highs and lower lows being formed. And this is a very classic behavior of a downtrend where the bears are firmly in control. So as we follow this chart, there is a significant level of resistance which has been tested multiple times, but what's even more important, that at this point the price action forms a double top, which is a bearish pattern that suggests that the bulls are struggling to continue. The price falls from this level, which is a typical response to such a pattern, and moves down to a higher time frame support that is marked just right here, and it was based on the daily chart. So after bouncing off the higher time frame support, we see a reversal in the market sentiment because the price starts to make higher highs and higher lows, which signals the beginning of an uptrend. Now, as you can see, during this uptrend, the price consistently moving above the moving averages of 20 and 50, which act as the dynamic support levels. And within this uptrend, we spot a bullish flag formation, but what's even more important, that we observe the price break above the upper boundary of the flag, followed by a cycle of push and exhaustion along with a bullish engulfing candlestick closure. Now, for the cherry on top, the trade results in reaching a profit of 160 pips in the profit. We can see that the uptrend resumes its trajectory, and that was with a risk-reward ratio of 1 to 2.5. And there you have it. I know it's a long video and there's a lot to digest, but this is a pretty good example of what's possible when you bring everything together. So trend analysis, support and resistance, chart patterns, and moving averages, because in this case you could potentially double your profits by trading a double top first and then the bullish flag as well. And the best part is that this isn't out of reach for you, because with consistent practice, patience, and commitment to understanding how the market works, you can target and achieve trades just as successful as this one and become a very, very profitable trader. So if you enjoyed this video, then definitely let me know in the comment section down below, and I will make more of these videos. But for those who really want to accelerate and elevate your trading to the next level, then my ultimate price action course is the way to go. It's basically all of my best knowledge from the last 5 years condensed into something that is easy to digest and can be actionable from day one you start reading it. But along with my ultimate price action course, you will get a lifetime access to my premium signals for free. So I will leave everything in my description box down below. Make sure to like this video, and I will see you in the next one. Bye!